Okay, so here we go, the meat of this chapter. So let's talk about transaction analysis. Okay, so we are basically going to start up a company right now, and we are going to properly record all the transactions involved in this simple startup situation. Okay, so here we go. Now we have, as you see, that same framework that we did before, where we have a balance sheet, which we're going to use as sort of a holding bucket to record the transaction, and then we're going to transfer relevant information down into the appropriate statements where they are, where they should show up. So this situation is, this is a doctor's office, Dr. Landry, and she deposits a $6,000 check in a bank account in the name of Family Healthcare PC. That's PC stands for Professional Corporation, in return for shares of common stock in the corporation. Okay, so she invests in the corporation and she issues herself ownership equity of $6,000. We have here our balance sheet format for recording the transaction. Our cash increases because we put money in the bank, and we balance that out by issuing common stock, and our assets equal our liabilities and equity. Now, in the cash flow statement, we separate out our cash flows into three general categories: financing activities, investing activities, and operating activities. Financing activities involve anything having to do with obtaining the funds that you need to start up or conduct your business through the issue of stock, perhaps, through taking on a bank loan, perhaps, or on the other side of that, by doing things like paying back your creditors or issuing dividends to your stockholders. Okay. So this cash that was received by the business from Dr. Landry's investment goes into the statement of cash flows as a financing cash flow. So our balance sheet is in balance, and we have indicated where that cash flow should be categorized. Okay, the next thing that she did, Dr. Landry did, when she started up her business, is that she borrowed $10,000 from the bank. So she put in $6,000 of her own money, and then she borrowed $10,000 from the bank. And the way that this needs to be recorded is that now she has even more cash in the bank, and she takes on a liability called a note payable. And so one of the things that happens in accounting classes is that these vocabulary words, notes payable, are kind of thrown out at you in the context of explaining these transactions and stuff. So, you're going to have to take it upon yourself. If you don't know the meaning of some of these words, you're going to have to take it upon yourself to look in the glossary in your ebook or to Google the definition of a notes payable. But you are going to have to sort of learn and remember that a notes payable is a kind of a liability. It's a bank loan that you owe to the bank. And so now we have, right, a total cash balance in the bank of $16,000. And that is made up of $10,000 in notes payable, $6,000 in common stock, our balance sheet balances, and this again shows up in the statement of cash flows as a financing activity, because you are acquiring the funds to start up your business in this case. Okay, our third transaction. We purchased, or the business purchased land for $12,000 cash. So this is how you record this transaction, right? You started with $16,000. You bought some land for $12,000 in cash, literally took a sack of money over to the seller and traded your sack of cash for, a quarter acre of land or whatever it is, right? Now in this case, and this will turn up in your homework, right? This is one of those transactions where you're just trading one asset for another, right? Nothing needs to be recorded over on this side because the net of these two entries here, the purchase of land and increasing the value of your land, they balance out to zero. There's no change in your asset category, so there's nothing needs to be shown up over here. You still have $16,000 in assets, but nothing has changed over here on your liabilities and equity side. And also, right, this is a $12,000 negative cash flow that was associated with an investing activity. Right, so financing activities have to do with acquiring the funds to pay for your investments or to help with your operations, and investing activities have to do with acquiring assets. Okay? Okay, and so here we go now. Now we're finally in operation. So during the first month of operation, we earned patient fees of $5,500, receiving the fees in cash. So our cash went up by the amount of fees that we earned. And I want to take you over here to this side of the equation, right? Retained earnings. Retained earnings is part of your stockholders' equity, as we learned last module when we were learning about the balance sheet. And retained earnings represents the net income that a company earns, the profit that a company earns, less any dividends that are paid to shareholders. It's the money, it's the profits that you keep in the company that you retain. And so when you earn those fees, when you earn revenues, right, that is going to increase your retained earnings over here. So again, right, our assets increased, we got cash, and our equity increased, we got retained earnings. And over here, now you see how this is becoming more complicated. Right now we've got 2 categories of assets, 3 categories of liabilities and equity. And then the other thing is, right, on our cash flows, all of these cash transactions have to be categorized, and this was an operating activity. Right, that $5,500 that was received due to the operations of the business. So this goes into an operating activity, and on the income statement we finally have an entry to the income statement, which is fees earned or revenues. Okay, so this now becomes just a little more complicated now that we are actually in business. Okay, so the next thing, we paid $2,900 in expenses. All right, so cash reduces by $2,900. Our retained earnings reduces by $2,900 as well, because remember, retained earnings is the profit in the company for that period less any dividends. So, we reduce retained earnings, so now we have retained earnings account of $2,600 in total. And again, we had a negative cash flow for operating expenses of $2,900. And then here in the income statement, this basically just breaks down all the different expenses that made up that, sort of summary transaction above. Right, so she paid wages, she paid rent, etc., etc. Okay, so that's how you record that transaction. And now, the last transaction that we need to record here is the payment of dividends. This is basically an owner's withdrawal, right? She paid herself. She paid herself $1,500. That reduced cash and reduced retained earnings. It did not have an effect on the income statement because dividends don't show up on the income statement, but it was a financing cash flow. Okay, a negative financing cash flow. And so at the end of all this, then we have this sort of summary page which shows all of these transactions, right, A through F. And what you do is you add up at the bottom of all this, you add up your balances in each of these accounts. So our cash balance is $5,100. Our land balance is $12,000. We owe $10,000 in notes payable. There was $6,000 in stock issued, and there's retained earnings of $1,100. Okay, the retained earnings, right, was $2,600 in net income minus the $1,500 in dividends. And then here are all our cash flows that are categorized by financing, investing, and operating activities. And so sure enough, right, if you just add up all these cash flows, that gets you to the $5,100, which should be the same as the $5,100 showing in your balance sheet. Everything balances, everything looks as it should. Now would be a good time for you to go to the practice problems. If we were in a face-to-face class, what I would have you do right now is we'd practice, right? So go to the practice problems and work through a few of these, okay? There's going to be a little bit more content, but really this is the meat of the chapter. There's not a lot of lecture to be had here. It's really just, okay, here's how the system works, now practice it, okay? So I'm going to stop this video here and then continue with just a little bit more content afterwards.